Many retirees discover that once they retire, their tax deductions disappear and their taxes actually may increase. So we're going to give you 3 tax tips to consider once you're retired, 3 ways that you can actually reduce your taxes in retirement.
The first thing we want to talk about is a Roth IRA conversion. Now, if you've watched our other videos, you know that we're huge proponents of this tax saving tip. So what does that mean for you? Well, let's look at Bob and Kay. Their annual income is about $80,000, which puts them in the 12% federal income tax bracket. So the top of that tax bracket is about $107,000. Now, remember, their annual income is $80,000, so you subtract that from the top of the bracket, which is $107,000. We're left with about $27,000 that they could convert to a Roth IRA paying 12% tax.
That means, Amber, that they won't be in any higher tax bracket, right? They're just taking advantage of the tax bracket they're in. And this is huge because, look, we're going to have to pay the tax on that at some point in the future. Why not pay it at 12%? That's a pretty fair rate. And here's the beauty of that. Once those funds are converted, they're never going to be taxed again. So if that $27,000 grows to $50,000, that's all tax-free. And what we like to do is set up plans that do this over and over and over again. So next year, if their income is $82,000, well, maybe they'll only convert $25,000 in that year. But the idea, Amber, continually be converting those IRA, 401k, or TSP plans to Roth. And there's really 3 primary reasons. Number 1, if taxes go up in the future and you need more income to cover those taxes, we can pull it down tax-free. Number 2, if you need long-term care in the future, you now have money you can pull down tax-free. Long-term care is expensive. $80,000 a year on top of the other $80 is going to put them in a much higher tax bracket. So we can pull funds down from the Roth account, not pay tax on it. And the third reason is if you don't need it, leave it to your beneficiaries tax-free.
Tax-free, yes. Your beneficiaries will love that.
Yes, they will. Second tax tip I want to give you is get credit for all those charitable contributions. You know, the tax law in 2018 changed and gave most people the benefit of taking just a standard deduction. So even if you give $5,000 or $10,000 a year to charity, you're probably not getting a tax break. So let's look at Bob and Kay's situation again. So again, Bob and Kay got $80,000. Their standard deduction at age 65 is $27,650. What does that mean? That means that all of the taxes that they pay up to the $10,000 cap, plus all of their medical expenses once they exceed 7.5% of their adjusted gross income, plus their charitable contributions must exceed $27,000 to get a charitable contribution tax deduction. So Amber, what does that mean? That means, so let's say Bob and Kay pay $10,000 of taxes during the year. They have $5,000 of medical expenses. That puts them at $15,000, and they give $10,000 to charity. That's only $25,000. They still don't get credit for that because they hit the standard deduction.
Yep, they still fall short. Okay, so what's a better way to do it?
Well, there's actually 2 ways. The first way is to create a donor-advised funds. So that's where you'd reach out to your advisor, someone like us, and say, I want to set up this donor-advised fund. And what does that mean? That means you can actually put aside a big chunk of money today into this fund and then give it out to charities in the future. So in this example, maybe Bob and Kay put in $50,000 one year into this donor-advised fund. They get the tax deduction this year, but then maybe they spread that out to charities over the next 3, 4, or 5 years. So by lumping all of these charitable contributions together, you can actually get tax credit this year, but then spread it out over several more years. The second way to get credit for your charitable contributions is to do what's called a qualified charitable distribution, or QCD. It's a little complicated, right? A lot of qualified things when it comes to the IRS, right? And here's how that works. Once a person's over age 70 and a half, they can give up to $100,000 per year directly from their IRA, 401k, or TSP directly to a charity. Bypass the required minimum distributions, bypass all the taxation. It goes directly to the charity and it satisfies the required minimum distribution. Now, Amber, I'm going to ask you, if each person can do $100,000, what could a married couple like us do? What do you think?
$200,000.
$200,000, right? So that's a lot of money per year you could give to charity and not have to pay tax on it. So that's another way to get credit, I guess, to call it, for your charitable contributions.
So tax tip number 3, consider putting your money into a tax-free long-term care policy. So you set money aside into a long-term care policy. Now, if you need long-term care, you have access then to a large amount of funds. Long-term care is very expensive. If you don't need it, your heirs will then inherit that money tax-free. So it's a great thing for your beneficiaries. And if you decide down the road that you don't need long-term care and that you don't really care about leaving it to your heirs, maybe you want to spend it, you can take that money back out tax-free.
That's right. And there's actually 2 ways to do this, Amber. You can set aside a big chunk of money, $100,000, $200,000 into a policy at one time, or go back to our example of Bob and Kay, where you talked about them converting $27,000 a year to a Roth. A portion of that could also go into a policy. So maybe they take $27,000 and they put $10,000 of that for 10 years into a long-term care policy, and the other 17 convert. So you can do a 10 pay. There's also another very little known tax trick that goes along with this tax tip. It is a trick because it only applies to a few people, and that's if someone has a non-qualified annuity. That means that an annuity that was purchased with after-tax dollars, the tax law actually allows them to transfer that to a new annuity with long-term care benefits and have huge tax-free gains for long-term care. So here's an example of Bob and Kay. Say that several years ago, Bob and Kay put $100,000 into a non-qualified annuity, and it's got $40,000 of untaxed interest in there. They've got $140,000 of value. They can take that untaxed interest of $40,000, combine it with their original deposit of $140,000, and transfer it to what's called a Pension Protection Act compliant annuity. Very technical. You're going to want to get an advisor who knows what they're doing on this. But once they do that, that $40,000 can be tax-free, and then it doubles again for long-term care. So in this example, they could have $420,000 of tax-free long-term care coverage, and all it cost them was the original $100,000 years ago, and all of that gain can be tax-free if used to long-term care.
So to recap the 3 tax tips: convert to a Roth IRA, one of our personal favorites.
Yep.
Second,
get a tax deduction for your charitable contributions. And the third?
The third, of course, is long-term care.
That's right. Now, if your advisor is not giving you these tax tips, maybe it's time to come work with someone who does. There's a link in the description below. You can click on that link. It takes you to watch our master class where you can apply to become one of our clients. Because you can make the rest of your life the best of your life.
Plan now to retire happy.